Welcome to ICAN Academy YouTube channel. If you are coming across my lecture for the first time, please don't forget to subscribe to the channel so that you don't miss my upcoming videos. And if you are a returning subscriber, I say thank you and God bless you. So in this lecture, I want to examine the accounting for hire purchase transactions in the books of the hire purchase buyer. In the books of the buyer. Or in the books of the vendee. I want to know that everything are in line with the double entry principles. Remember the principles of double entry, which states that for every debit entry, there must be a corresponding credit entry. So, in my first two videos on hire purchase, I've examined how to spread the hire purchase interest. I've given the general overview. I've explained the various terms used in the hire purchase transactions. Then this is the top video on the topic. So for completeness, I will advise you watch my two other videos or just search for ICAN Academy playlist on financial accounting. Now, what are the accounts required? Accounts required using what? Hire purchase interest accounting method. Because there are two methods of accounting for hire purchase transactions. We have using the hire purchase interest account method and using hire purchase interest suspense account method. But in this video, I will examine hire purchase interest accounting method. The next video, I will examine hire purchase interest suspense account method. Now, using hire purchase interest account method, what are the accounts required? Number one, we have hire purchase asset account. Asset account. Remember, this is in the books of the buyer. The buyer is going to record it as an asset, despite the fact that the buyer hasn't paid the last installment. This is where the substance over form accounting concept comes in. Substance over form concept, which will find that financial reality takes precedence over legal form. So financial reality takes precedence over legal form. Hire purchase payable accounts. At least hire purchase creditors account. Number three, no, it is the buyer that will record, we open the account with the creditors, because creditors is just this payable account. This is just a creditors to the buyer. Buyer is the debtors, while this person is the creditor. The seller is the creditor to the buyer. So we also have the cash book. The cash book. Number four, we also have hire purchase interest account. Hire purchase interest account. Remember, my focus is using hire purchase interest accounting method. Number five, we also have, this, let me say, hire purchase interest expense. Interest expense account. Because the interest payable by the buyer is an expenses of the buyer. It's an expenses to the buyer. So number five, we have depreciation expenses account. Depreciation expenses account. Then we also have accumulated depreciation account or provision for depreciation account. Accumulated depreciation account or provision for depreciation account. Number seven, we also have statement of profit or loss. Statement of profit or loss extract. The extract of it. So you may also need to prepare that. Then we also have statement of financial position. Statement of financial position. The extract of it as well. Extract. The extract of it. So These are the accounts required in the books of the hire purchase buyer, in the books of the hire purchaser, in the book of the purchaser, in the book of the vendee, in the book of the buyer. The vendee, the purchaser, the buyer mean the same thing. So take note of this. I've told you that everything must be done in line with the principles of double entry, which says that for every debit entry, there must be a corresponding credit entry. I want you to note that when you enter a transaction on hire purchase, now let's look at the stages involved. Stages involve the hire purchase transaction. The first thing, we are looking at the buyer position. Buyer position. The first thing, they will acquire an asset. So we have acquisition of asset or hire purchase. Acquisition of asset. After this asset has been acquired, the buyer will be asked to make a deposit outrightly. Then after this deposit, then the buyer will also make some periodic installments until the final installment is paid. So until the final installment is paid. Then the buyer will be charged interest. And this interest that will be charged will form part of the installment that is payable. The interest will have been included in the installment, because the installment will comprises the cash element and the hire purchase interest. Meaning that the installment will comprise cash element. The cash element and the hire purchase interest. These are the two components or composition of the installment. I want you to take note of this. Now, what are the accounting entries required in the books of the buyer? Accounting entries. I've told you that the first thing is acquisition of assets. Acquisition of assets or hire purchase. They acquire an asset or hire purchase. That is the first thing. So when they acquire an asset, so who is the giver? The seller. And I've told you that the seller is the creditor, which is the same as the payable account. The hire purchase payable account or hire purchase creditor, that is the seller or seller account. Let me put seller. So the seller is the giver. Remember, in line with the double entry principle, we credit the giver, debit the receiver. So since seller is the giver, seller is giving out an asset to the buyer, while the buyer is receiving an asset. So what the buyer is receiving is an asset. So we are going to record it as hire purchase asset. So you debit, since asset is what is received now, debit hire purchase asset account. Hire purchase asset account, you debit it. You now credit the seller who is giving out the asset. So you credit hire purchase payable account or hire purchase creditors account. So if you want to use ISB conceptual framework, if you want to use the terminology from the ISB conceptual framework, you use the word payable. But if you want to use the normal term, which has formed part of the Nigerian Accounting Standard, NASP, you use creditors account. So, number 2, an asset has been acquired or hire purchase. Now, the buyer will be asked to make some deposit. With deposits paid, with deposit paid. Remember, the buyer is the one making the deposit now. The buyer is giving out some money now. That means what the buyer is giving out is cash or check. Let me just say cash. The buyer is giving out cash. Then who is now receiving this cash from the buyer? The receiver becomes the payable. Hire purchase payable. So the creditors, the seller is the one receiving the cash. I've told you that the seller is the creditors, which is the payables account. So since seller is the one receiving it now, you are going to debit hire purchase payables account. Debit hire purchase payable account, and you credit cash book, cash or bank account with the amount paid as deposit. Then number 3, the deposit has been paid. The buyer also will be asked to make some periodic payment called installment. So upon the payment of the installment, the buyer is given out cash, while the seller is the one receiving the cash. The seller becomes the receiver. I've told you that the seller is the payables account. Therefore, payable is the receiver, and the buyer is given out cash. So you credit cash, you debit the payable with the installment payment. With installment payment. So you debit hire purchase payables account, because payable is the seller, is the one receiving that installment. You credit what? Cash book of the buyer, because the money is going out from the bank of the buyer. Now, number 4, you are going to recognize hire purchase interest. Recognition of hire purchase interest. If you want to recognize hire purchase interest, I've told you that the hire purchase interest is an expense. It's an expenses to the buyer. And expenses will have a debit balance. Therefore, recognition of hire purchase interest, you debit hire purchase interest expenses account. You credit hire purchase payables account. I've told you that you either call it payable or creditors. Then, at the year end now, at the end of the period, the entity will also charge depreciation on the asset. The buyer will charge depreciation on the asset. Then the interest also will be transferred to the statement of profit or loss at the year end. Now, number 5. Number 5, at the year end. At the year end, let me have recognition of depreciation. When you recognize depreciation, depreciation is an expense. An expense will have a debit balance. So you debit depreciation expenses account. And you credit accumulated depreciation account. This depreciation will now be transferred to income statement. You transfer the depreciation to statement of profit or loss. Profit or loss. So in that case, you are going to recognize depreciation as an expense in the statement of profit or loss. So you debit statement of profit or loss, of profit or loss, and you credit depreciation expenses account. Or you can bypass this stage. If you want to bypass this, that means in that case, when you recognize depreciation, you debit the statement of profit or loss, and you credit accumulated depreciation. So that will be the double entry. Then transfer the hire purchase interest to statement of profit or loss. let me say, transfer hire purchase interest to statement of profit or loss. So in that case, you debit, no, you are transferred, you have debited hire purchase interest expense here. So you now credit this account, you debit the profit or loss. So debit statement of profit or loss and credit hire purchase interest expenses account. So this is the double entry. These are the double entries. These are the double entries required in the books of the buyer. Example, X Limited purchased an office equipment on 1st January 2021 from Y Limited on hire purchase terms, under which X Limited paid a deposit of 61,505 naira to be followed by 4 annual installments of 50,000 naira, each payable on 31st December. Interest is charged on outstanding balance at 10% per annum. The cash price of the equipment is 220,000 naira. The accounting year of both companies ends on 31st December. Depreciation on the equipment is at 20% per annum on straight line basis. All the sums due were paid on the due dates. Show the relevant ledger entries in the books of S Limited and statement of financial position extract at 31st December 2023. So, in answering this question, the first thing is to determine the fair value of the equipment. So now, let's have the solution. What is the fair value? I've told you that you apply the annuity formula, annual installment into 1 minus 1 plus r raised to power minus n over r. And if you go back to the question, the deposit is 61,505 to be followed by 4 annual installments of 50,000 naira each. 4 installments of 50,000. So our A is 50,000 into 1 minus 1 plus, what is the rate of interest? Interest is charged on outstanding balance at 10% per annum. The interest rate is 10%. R is 10%, which is 0.1, raised to power n minus 4 installments over R, 0.1. So which is 50,000 into 1 minus, this is 1.1, raised to power minus 4 over 0.1. So we have 1.1 raised to power minus 4, 1.1 raised to power minus 4. Then if you subtract it from 1, it will be 0.316986 divided by 0.1, then times 50,000. So the fair value equals to 158,493. This is the fair value. Let's compare it with the cash element. If you go back to the question, you were given the deposit of 61,505 and the cash price of the equipment is 220,000. So if you have cash price 220,000, if you let the deposit deposit of 61,505. Then the difference is 158,495. Remember, I've told you the lower of the two will be used. And the fair value is 158,493, and this is 158,495. Just difference of two. The difference of two will be assumed to be a rounding of error. So we can assume these two values are the same. So because of that, we can ignore the calculation of the fair value. So if this and this, if you assume they are the same, because due to the difference of two is due to rounding of error, so you can just use this. But where this is lower, let us assume this is 158,495 and this is 200,000. That means this will be used. And if this happens to be 158,495 and this happens to be 180,000, then we use this. The lower of the two will be used. But we are assuming this and this are the same in this question. We assume they are the same because the difference of two is as a result of rounding off error. So we can just go ahead and use this as the fair value. So at this juncture, you can prepare the hire purchase amortization table. Let's have hire purchase amortization table. So we have here, we have opening balance, opening balances. Then we have hire purchase, interest. Then we have instrumental payment. Then we have the closing balances. Closing balances. Since we have assumed that the fair value and the fair value and the cash price, we assume they are fairly the same. Approximately, we assume they are equal. So we can use this now. They have 4 years, 4 installments. 1, 2, 3, 4. Then the opening balance 158,495. 158,495. Hire purchase interest at what rate? Let's go back to the question. Interest is charged on outstanding balance at 10% per annum. The rate of interest is 10%. At 10% now. 10% of 158,495. So you have 15,850 approximately. The installment, the annual installment is how much? 4 annual installments of 50,000 naira. So the installment is 50,000. So 158,495 plus 15,850 minus 50,000. The closing balance is 124,345. The closing balance in year 1 will be the opening balance in year 2. 124,345. If you calculate 10% of this, you'll be having 12,435. 10% of this will give you this. Installment is still 50,000. So this plus this minus this. Then you have 86,780. That is the closing balance in year 2, which will become the opening balance in year 3. 86,780. Then 10% of this will be 86,780. 86,780. Installment is 50,000. So this plus this minus this. Then you have 45,458 as the closing balance. That will be the opening balance in year 4, 5,458. If you calculate 10% of this, it will be 4, 5, 4, 4, 5, 4, 5, 4, 4,545 approximately, and the closing balance is 50,000. If you have this plus this minus 50,000 plus 4,545, so you have 4,545 45,458. If you add this one, it will be greater than 50,000 by 3. So you can just round down this one to 2 to compensate for the rounding off error. We rounded this from 5 to 2 in order to compensate for the rounding off error. If you now have this plus 4,542 now, it will give you 50,000. Minus 50,000, the closing balance will be nil. Remember, we rounded this from 4,545 down to 4,542 in order to compensate for the earlier rounding off error, so that we can have exactly 50,000, so that the closing balance will be nil. If you use 4,545, it is not bad. It is still correct. So just that you are having 3 as a rounding off difference. So this is the hire purchase amortization table. Now we want to show the necessary ledger entries to record these transactions. Now let's open the necessary ledger account. So you have to open what? Show the relevant ledger entries in the books of S Limited. Who is X Limited? Who is S Limited? Go back to the beginning of the question. S Limited purchased an office equipment. So S Limited is the buyer, since it is the S Limited that purchased the equipment. So that is to show that you are making the entry. You want to record everything in the book of the buyer. I've told you that the buyer will open the vendor account. The vendor is the seller. Now, office equipment on 1st of January 2021 from Y Limited. Y Limited is the seller. So in the book of S Limited, you are going to have Y Limited account. And the transaction between S Limited and Y Limited, they purchase the equipment on hire purchase. They purchase office equipment. So that means you are going to open office equipment account. Remember, I've told you that this is where the substance over form concept comes in. That the financial reality take precedence over legal form. Despite the fact that the final installment have not been paid, the asset, the equipment have not belonged to S Limited. S Limited will still record it as an asset in his book. That is what we mean by substance over form. The substance of it is the monetary aspect of it. You record it, it will prevail over the legal form. The legal form says that this property will only belong to S Limited when S Limited is able to pay the final installment. But in accounting parlance, you will still record the asset in the books of the S Limited, despite the fact that S Limited hasn't paid the final installment. S Limited hasn't paid the last installment. So that is what we mean by substance. You are recording the substance of it over what? Over the legal form. The legal form is that this property will belong to S Limited when S Limited is able to pay the final installment. But the accounting parlance says that you will record it, you will record the monetary aspect of it, since it is S Limited that exercise control over the equipment. So we want to open the equipment account. Entries in the books of X Limited. So we want to open office equipment account. Office equipment account. The debit side and the credit side. Then we will equally open account of Y limited. Y limited account. That is hire purchase vendor account. That is the seller account. Now, the first thing is that the first transaction that will occur between the vendor and the vendee is the buying and selling of the asset. So you have the acquisition of the asset on hire purchase. The asset was acquired for 220,000. When you acquire the asset on hire purchase, the vendor, the seller, gives out the asset to the buyer. The buyer will receive that asset, will receive the equipment in form of an equipment. The buyer will receive the asset in form of equipment. That means the asset of the buyer will increase. So you are debiting the office equipment account, and the seller who gives out the equipment, you credit his account. You credit the account of the seller, the Y limited account. Now, and when the date of the transaction, no, they said the transaction occur as at 1st of January 2021. So you have January 1, 2021. So acquisition of assets on hire purchase, you debit the office equipment account, you credit the seller account. So we have January 1, 2021. Have hire purchase office equipment account. Office equipment account. That is 220,000. So this is 2021. 2021. So you debit, you have January 1, 2021, you have Y limited account, that is the seller account, 220,000. That was the transaction they entered into. That is the cash price of the equipment. Now, remember, the buyer made some deposit outrightly. With the deposit made now, the buyer paid a deposit of 61,505. With the deposit paid by the buyer will give out cash. That means the cash is the giver. The cash goes to who? To the seller. So meaning that the hire purchase, the Y limited, which is the seller, is the one receiving that cash. So you debit Y limited account, you credit the cash book of X limited. X limited is the buyer who pays the money to Y limited. Y limited is receiving the money, so you debit the Y limited, debit the receiver. So now we are still in 2021. So we have January 1. So we have cash deposit of 61,505. That was the deposit made by X limited at the sanction of the transaction. So we debit Y limited, who received the money, the seller who received this deposit. So you debit the seller's account, while the cash book of the buyer will be credited. So we credit the giver, debit the receiver. Now, to be followed by 4 annual installments of 50,000 each payable on 31st December. As at December 31st of 2021, the buyer will also pay certain installments. With the installment paid now, this installment is paid to Y limited, who is the seller. So Y limited is receiving the installment, so we debit the Y limited, you credit the cash book of the buyer. So December 31st, we have cash. The installment paid, which is installment. This is installment. This is deposit. 50,000 is the installment. So that is upon the payment of installment. At the accounting year end, you are going to recognize the hire purchase interest. With the hire purchase interest for the period now, you debit So, you know, the higher purchase interest is an expense. Now, let me open. Higher purchase interest expenses account. Debit side and credit side. We now recognize higher purchase interest. Remember, interest is an expense. Remember, I've told you that an expense or expenses should have a debit balance. Therefore, you are going to debit the higher purchase interest expense account. You credit the vendor, the Y Limited. So, how much is the interest for 2021? 15,850. So, as at December 31st, now have higher purchase interest. Interest for first year is 15,850. 15,850. Then you debit the higher purchase interest expense account. As at December, first year is 2021. December 31st, you have Y Limited. You know the credit entry is in the Y Limited account. 15,850. 15,850. Now, let's close the account. In 2021, let's close the account. So, if you add this and this, it will be 235,850. If you add this and this, it will be 111,505. 61,505 plus 50,000. 111,505. You should subtract it from this. Minus 235,850. The difference is 124,345. So the total is 235,850. This balance, this is the balance, the closing balance, December 31st, balance carried down. After 2021, the years that follow is 2022, 2022, 2022. The closing balance here becomes the opening balance in 2022. So January 1st, balance brought down. And that is 124,345. 124,345. Remember, in 2022, another installment of 50,000 will be paid. With the installment paid in 2022 of 50,000, the Y Limited becomes the receiver, because this installment will be paid to Y Limited. So you debit Y Limited. Let me first of all recognize the interest of 12,435, because I want to rub it off. 12,435. Recognition of higher purchase interest. December 31st. We say it is 12,435. That is higher purchase interest. So in 2022, so we are still going to have December 31st, higher Y Limited, 12,435. Then, when that installment of 50,000 is paid, Y Limited is the receiver. December 31st, 2022, we have cash, that is with the installment paid, installment, and that amounted to 50,000. So, Y Limited is the receiver. That is why Y Limited account has been debited in 2022. So we have 124,345 plus 12,435. Then you have 136,780. So as at December 31st, balance carried down. So if you subtract 50,000 from 136, 780, then you have the difference of 86,780. The total is 136,780. Then you have 2023. 2023. The closing balance here becomes the opening balance. You have January 1, (2023). So we have January 1st, balance brought down. The closing balance 86,780. 86,780. Then, as of December 2023, another installment will be paid. Cash, that is installment. Installment of 50,000. 50,000. Then, at the end of the year, 2023, you recognize higher purchase interest. You have higher purchase interest of 8,678. December 31st, HP interest. Higher purchase interest 86,78. 86,78. So now in higher purchase interest account 2023. So December 31st, you have Y limited. That amounted to 86,78. 86,78. Now let's close the account. 86,78 86,780 plus 86,78. That is total 95,458. 95,458. Then as at December 31st, you close the account here. Balance carried down. That is, if you subtract 50,000 from 95,458, you'll be left with 45,458. The total is 95,458. That is for 2023. The year 4, which is 2024. The year 4. And the year 4, the fourth year is 2024. You have the closing balance here becomes the opening balance. January 1, balance brought down. And that amounted to 45,458. 45,458. Then another installment will be paid as at December 31st, 2024. December 31st, we have cash. That is with the installment paid. An installment is 50,000 annually. As at the end of 2024, you are going to recognize higher purchase interest, and the higher purchase interest is 4542. 4542. December 31st, HP interest 4542. Now, let's open another account, 2024 now. So, we had December. This is higher purchase interest account. December 31st. We have Y limited. And the interest is 4542. 4542. 4542. Let's close this account. If you add this and this, plus 4542, this is totaled 50,000. Then the debit side, here you have the installment of 50,000. So it's balance 50,000. So that is Y limited account, the vendor account. The next account is the accumulated depreciation account. Accumulated depreciation account or provision for depreciation account. The first year is year 2021. 2021. Depreciation is an expense. So you are going to debit depreciation expenses account, or you debit the profit or loss account, and you credit accumulated depreciation account at the end of the year, December 31st. So let me see if you debit profit or loss. And how much is the depreciation? You were told depreciation on the equipment is at 20% per annum. So you calculate 20% of the cash price. 20% of 220,000. That is 44,000. 20% of cash price of 220,000. That gives us 44,000. So that means the profit or loss. Profit or loss will be debited as an expense. So that is 2021. You close the account at the end of the year, December 31st. You have balance carried down 44,000. Then you enter another year, 2022. 2022. Then the closing balance here becomes the opening balance. January 1, balance brought down. That is 44,000. Then at the end of the year or so, you are going to expense the depreciation, December 31st. Profit or loss. Since the method of depreciation is straight line, depreciation method is straight line, that means same amount will be charged, 44,000. So if you sum it up, you have 88,000. As at the end of the year, you close the account, December 31st, balance carried down, 88,000. 88,000. Then you have 2023. 2023, you have January 1, balance brought down. The closing balance here becomes the opening balance, 88,000. Then as at the end of the year also, you expense your depreciation, December 31st, profit or loss. Depreciation of 44,000 will be expensed. 44,000 plus 88,000. Then you have 132,000. As at the end of the year, you close the account, December 31st, balance carried down, 132,000. 132,000. 2024. 2024. The closing balance in 2023 becomes the opening balance, January 1. Balance brought down, 132,000. So, as at December 31st, you have profit or loss. That is depreciation that will be expense, which is 44,000. If you add 44,000 and 132,000, then you have 176,000. The closing balance, December 31st, balance carried down 176,000. 176,000. Then in 2025, this will be the opening balance, January 1. Balance brought down 176,000. So that is for that. Now let's close the office equipment account. December 31st, you have balance carried down 220,000. Then in 2022, the closing balance in 2021 becomes the opening balance in 2022. January 1st, balance brought down 220,000. Then you also close the account at the end of 2022. December 31st, balance carried down 220,000. Then the third year is 2023. 2023, as at January 1st, balance brought down 220,000. That is, the closing balance in 2022 becomes the opening balance in 2023. So at the December 31st, 2023, you also close the account. So you have 220,000 as well. Then 2024, the closing balance here becomes the opening balance, January 1st. Balance brought down. That is 220,000. Then you also close the account, December 31st, balance carried down 220,000. Then 2025, you have January 1, balance brought down to 20,000. That is for the office equipment account. Then the balance in higher purchase interest account. The balance in higher purchase interest account will be close to statement of profit or loss. So December 31st, this is 2021. December 31st, you have statement of profit or loss. That is 15,850. Then 2022 as well. The balance you have is 12,435. December 31st, statement of profit or loss as well. That is 12,435. Then 2023, December 31st, statement of profit or loss. The amount is 8678. 8678. Then 2024, December 31st, statement of profit or loss. Profit or loss. 4542. 4542. Finally, we want to have the statement of financial position extract for 2023. X Limited, statement of financial position extract as at December 31st, 2023. So we have carrying amount. Carrying amount. We have accumulated depreciation. Then we also have the cost. The first thing is the non-current asset. Non-current assets. Under non-current asset, we have office equipment. Office equipment. The cost of office equipment as of December 2023, that is 220,000. 220,000. That is the cost. 220,000. Now, if you go to the accumulated depreciation account, December 2023, accumulated depreciation of 132,000. 132,000. If you remove 132,000 from 220,000, then you have the carrying amount of 88,000. Then under current liability, since at the end of 2023, we have only 1 year more left to liquidate the liability. So we are going to recognize it as current liability. Under current liability, we have Y Limited. The closing balance in 2023 is 45,458. 45,458. That is the end of the solution to this question. In my next presentation, I will examine where hire purchase interest suspense account method is used. Please don't forget to like the video.